There's a particular method I've developed in terms of actually, testing these strategies. Step number one, and I'm going to try to chat in these notes so we can kind of keep track of what we're talking about here. And I hope we'll have time. I'd love to talk about some individual currency pairs, including the pound dollar as well, because there is an interesting story with the pound dollar. But number one, in terms of testing a strategy, okay, so we're strategy testing. Okay, let me type this in. Strategy testing. Okay. So step number one is we want to come up with a simple idea. It's important. It's a simple idea. We always, I always tend to fall into the trap of trying to come up with a strategy that's very, very complex because the market's very, very complex, and therefore we have to have a complex, very complicated strategy to match that market condition. I think the opposite is true. I think we have to come up with a very simple, singular idea. I am going to create a trading strategy that's going to work well in a very specific trading and market condition, and then I'm going to simply wait for that market condition to take place, and when it does take place, then I'm going to apply it. Okay, so let's come up with a simple idea. And it can be a trending market, and we're going to talk more about this, trending versus range-bound markets, etc. Come up with a simple idea, though, and the easiest way to do so is apply one technical indicator. It could be the moving averages, Bollinger Bands, MACD, RSI. Any one of these indicators is perfectly fine. I will use one, maybe two indicators to create the strategy. I'll show you, and I have a lot of examples of actual strategies that I've worked with, and I hope I'm going to give you a lot of food for thought so you'll be able to take this on your own. Step number two is once we come up with the idea, we're going to say, let's actually go back to the euro dollar over here. Okay, so we're going to come up with this very simple idea. We're going to say, okay, the euro dollar is in a trending market, and the easiest way to identify a trending market is to draw trend lines. Okay, so the trend lines are established on a daily chart. A trend line that is sloping down means the sellers are pushing us down and the buyers are willing to pay less of a price. And we have a declining resistance, declining support. That creates a trend. Obviously, if it was going up, then it would be an uptrending market. This is a trend. So the simple idea is, how do I take advantage of a trending market condition? Well, the rule of thumb is the trend is your friend. Always try to trade in the same direction as the trend. Now, once we do that, well, it's easy to say, well, we could stick to the daily charts, and we could say, okay, I'm going to sell short every time the market tests this resistance line. Unfortunately, with daily charts, it doesn't really help us a lot because, well, the last time we tested this resistance line was beginning in December. That means that if we sold short the euro dollar, well, we'd probably still be short. And if we did not, for the past month and a half, we would not have been able to sell short. So from this point moving forward, I then move to a shorter term time frame. That could be a 4-hour chart or a 1-hour chart. There's no right or wrong answer. The time frame, and I think this is a misconception by many, that there's one good or bad time frame. The time frame should match our trading style. Now, personally, I find the most comfort in swing trading, where I'll take a trade that I'll hold for several hours and maybe even several days. Because the foreign exchange market doesn't close, we have the ability to sell short the euro dollar and literally hold on to it and hopefully make, several hundred pips, if not more. So, but if we're a day trader, we would also start from the beginning. I always like to start with a daily chart, long-term time frame, but then instead of moving to a 4-hour chart or a 1-hour chart, I may move down to a 15-minute chart. There's a number of different steps that we can go down as far as decreasing the time frame to match a trading style. I want to digress just for a moment. There is a massive draw towards day trading and scalping, and I'm speaking from personal experience. Before being involved in the foreign exchange market, I was a full-time stock trader, day trader, for years. I'll say this with all the certainty in the world, that it is the most difficult way to make money in financial markets is short-term trading, day trading, scalping. Now, I understand the attraction in terms of stock traders, because when you day trade stocks, we aim to make 10, 15 cents, 20 cents in the stock, maybe 50 cents. If you make $1 on a day trade, that's a really big day trade. But the reason why stock traders day trade, that they have to close their trades before 4 p.m. Eastern when the New York Stock Exchange closes, or wherever your regional exchange closes, you take an enormous amount of risk, because a stock market will close at 4 p.m., the stock will close at 50, news could come out, the stock could open at 100 or it could open at 20. Now, if I'm entering the market with the intention of risking 20 cents to try to make 20 cents in a day trade, well, if the stock gaps open $10, $15, $20, that could not only destroy the trade, that could destroy my career as far as day traders are concerned. Because day traders use very, very large position sizes relative to their account. They use a lot of margin to make a very small amount of money consistently. With foreign exchange, with forex, we don't have that risk. This market opens at Sunday at 7 p.m. or 4 p.m. Eastern, depending which broker you use. It's open 24 hours a day. It's open through the Friday close. So we have six and a half days without the possibility that the euro dollar will close at 128 and open at 138 or open at 130. We rarely, if ever, see any kind of gaps. Normally, in terms of stock day trading, we have 2-to-1 leverage, or at the most, maybe 4-to-1 leverage. But stock day traders, when you work for a day trading company, they'll actually give you much more. They'll give you forex type of leverage, but they also take on a lot of risk. Actually, to be honest, I haven't day traded stocks in quite a long time, so the industry has changed a bit. But typically, when we get into a day trade in stocks and you decide to buy 1,000 shares of a stock with the intention of making 20 cents or losing 20 cents, when the market closes, then anything can happen at all, and it's very, very dangerous. And when I trade stocks now, I prefer personally to trade stocks in the form of options, because options you have a limited amount of risk. But I don't want to digress because we have a lot to talk about in the forex market. This is why we're all here. Okay. So we have a downtrend on the euro dollar in the daily chart. Now we've moved to a 4-hour chart. I'm a swing trader, so I'll move to a 4-hour chart and go to the Bollinger Bands. Now the Bollinger Bands is a very easy indicator to use. We have a 20 simple moving average, which is SMA, which is the center line. Then we have an upper Bollinger Band and a lower Bollinger Band, which is simply this simple moving average, extended 2 standard deviations above and below the center of the range. In a downtrend, we only want to trade in the same direction to the downside. So I only want to look for trades to sell shorts. Now, to sell short, and the way the Bollinger Bands with the 2 standard deviations work is that with 2 standard deviations, if you plug the math in, about 95% of the candlesticks you will find take place in between the upper band and the lower band. Only about 2.5% of the time does the market travel below the lower band or above the upper band. 2.5% of the time below the lower band, 2.5% of the time above the upper band. So logic would dictate that if we're in a downtrend, number one, we want to sell short. Number two, we want to do so when we have the best probabilities of making money and the least probabilities of getting stopped out. Well, to do so, I would want to sell short right near the upper band. Now, some traders will take profits in the simple moving average. Some traders will take profits in the lower Bollinger Band. There are different, pros and cons to either approach. But this right here, that is our strategy. Now, I'm going to give you later on, I want to talk about a few different ideas for different strategies, but this is the strategy. And if we were to apply this to, let's say, the dollar CAD chart, dollar CAD, there we go. No, it's dollar yen. There's dollar CAD. Okay, in dollar CAD, we do not have a range. Now, we can still apply the Bollinger Bands, but in a much different way. Not actually a much different way. With a range-bound pattern like we have here, where the resistance is moving lower and the support is inclining higher, we would still use the Bollinger Bands. We would still go to a 4-hour chart, but then we would adopt a buy low, sell high approach, where we'd buy near the lower band, sell near the upper band, and take profits in the middle. So, 2 very, very simple examples, 2 indicators. Number one, the trend lines, daily charts. Once we determine the condition of the market on a daily chart, then we go down to a shorter term chart to really try to find a better entry.